The bank account you think is yours is built on a lie. It's a comfortable lie we all agree to believe. But in March 2023, the Federal Reserve quietly created a $1.2 trillion program to keep that lie from collapsing. A program that reveals why, in a real crisis, you might not be able to get your money out. It starts with a simple misunderstanding. Your money isn't sitting in a vault with your name on it. The moment you deposit it, the bank loans it out. It becomes a mortgage for a family in Ohio, a car loan for a student in Texas, a business loan for a startup in California. This is called fractional reserve banking. Your account balance is just a digital promise, an IOU from the bank saying they'll give you the cash when you ask for it. For over a century, this system worked. Banks kept a small fraction of cash on hand for daily withdrawals. The rest was out in the world, earning the bank money. The system runs on confidence. As long as we all believe we can get our money, we don't all ask for it at the same time. But social media and the smartphone just broke that confidence forever. Consider Silicon Valley Bank. On the morning of March 9, 2023, some influential tech founders on Twitter raised the alarm. They told people to pull their money out immediately. In the old days, a bank run was a physical thing. People had to line up around the block. It was slow, it was visible. You had time to react. But this was different. This was the first digital bank run in history. People weren't lining up. They were tapping, swiping, moving millions with a flick of the thumb from their living room couch. In a single day, depositors tried to pull $42 billion out of SVB. That's $1 billion an hour. No bank on earth can survive that. The FDIC, the government agency that insures your deposits, stepped in. They have a rule. They insure your money up to $250,000. But at Silicon Valley Bank, over 93% of the deposits were uninsured. They were accounts held by businesses, with millions of dollars needed for payroll and operations. If the FDIC only covered the insured amount, thousands of companies would have instantly gone bankrupt. They couldn't pay their employees. The entire tech industry was on the verge of a catastrophic domino effect. So the government broke its own rule. Treasury Secretary Janet Yellen announced they would make an exception. All depositors, even those with tens of millions in their accounts, would be made whole. They called it a systemic risk exception. They did the same for Signature Bank, which collapsed just 2 days later. Problem solved, right? The government saved the day. Wrong. They just revealed the real crisis. Why did these banks fail so quickly? It wasn't because of bad loans. It was because of good bonds. Government bonds. The safest asset you can possibly own. Banks hold trillions in these bonds. During the years of near-zero interest rates, banks loaded up on them. They paid a low but stable return. But when the Federal Reserve began aggressively raising interest rates to fight inflation, a disaster began to unfold in slow motion. Basic bond math is simple. When new bonds are issued with higher interest rates, old bonds with low rates become less valuable. Nobody wants your 2% bond when they can buy a new one that pays 5%. Suddenly, the safe assets on the bank's books were worth far less than what they paid for them. They had massive, unrealized losses. They hadn't sold the bonds yet, so the loss wasn't official. But it was there, a poison lurking on the balance sheet. By the end of 2022, the FDIC reported U.S. banks were sitting on $620 billion in these unrealized losses. Some economists at Stanford estimated the total market value of all bank assets was actually $2 trillion lower than what the banks were claiming on their books. Silicon Valley Bank needed cash to pay its depositors. To get that cash, it had to sell some of its bonds, but it had to sell them at their new lower market price. That single sale forced the bank to make its unrealized loss a very real one. It crystallized the poison. That's what spooked investors. That's what started the $1 billion-an-hour digital bank run. Every other bank in the country had the exact same problem. They were all sitting on the same toxic, devalued bonds. Any one of them could be next. This was the moment the entire system stared into the abyss. And this is where the $1.2 trillion secret comes in. The government couldn't bail out every bank. They needed a way to stop the bleeding without looking like they were printing $1 trillion. So they announced something called the Bank Term Funding Program, or BTFP. It sounds boring. It was designed to sound boring. But it's one of the most radical financial interventions in history. Here's how it worked. The Federal Reserve told the banks, "Give us your bad bonds. Give us those bonds that have lost 20 or 30% of their value. And in exchange, we will give you cash equal to 100% of their original value, not their current pathetic market value, their face value, their par value." It was an accounting trick, a magic wand that turned toxic assets into pure cash. Banks could now get the liquidity they needed without having to sell their bonds at a loss. It stopped the dominoes from falling. It papered over the $620 billion hole in the banking system. What was the size of this new program? The Federal Reserve made up to $1.2 trillion available. So the system is safe now. Your money is fine. But you have to ask yourself, what is the price of this new stability? The price is a trap. The Bank Term Funding Program was a temporary fix, scheduled to end in March 2024, and it did. But the problem of those devalued bonds hasn't disappeared. The unrealized losses are still there. The banks are still vulnerable. The system is now addicted to this emergency liquidity. The government proved they will do anything to prevent a bank run. And that means the banks will do anything to prevent you from starting one. This is why you might not be able to close your account. In a future crisis, if a bank gets a whiff that too many people are pulling out funds, they won't just let it happen. They won't fail like SVB. They've learned their lesson. They will act to slow the outflow. They will use the tools they already have. Your large wire transfer might be delayed for security reasons. The website might conveniently go down for unscheduled maintenance. Daily transfer limits could suddenly be lowered. They might demand you show up in person to a physical branch to move significant funds, knowing full well that slows everything down. They won't call it a trap. They'll call it prudent liquidity management. They'll call it protecting their customers. They'll do everything in their power to stop a digital bank run before it can go viral. Because the entire system, propped up by the ghosts of the BTFP, cannot survive another $42 billion day. The lie of fractional reserve banking has been replaced by a newer, more fragile one. The lie that an accounting trick at the Federal Reserve is the same as a bank being financially sound. It isn't. The promise that your money is yours to command instantly, at any time, has been broken. It was broken the moment the government decided the stability of the system was more important than your freedom to leave it. Understanding this isn't about panicking. It's not about stuffing cash under your mattress. It's about recognizing the new rules of the game. Your money in the bank isn't just cash. It's an unsecured loan to a highly leveraged institution that is now dependent on government backstops to survive a crisis. That knowledge itself is a form of power. It prompts you to understand FDIC insurance limits, to question where your money is held, and to see the headlines about the economy not just as numbers, but as signals about the strength of the promise your bank made to you. The system didn't break in 2023, but it did show us exactly how it would break, and the emergency repair job left the exit door much, much narrower than you think. If you want to understand the new rules of money and how to navigate a system that is constantly changing beneath our feet, subscribe. Because the most expensive thing you can do is not pay attention.